So we followed up Friday's great day with another no, it wasn't a really good great day. So it would have been nice had we followed up Friday's great day with another really good, big, great day today. That's how it kind of works when we're kind of, forming a low. But we had like a nothing burger day today. We had no range, no volume, flat, like we closed practically where we opened, very small, up and down moves throughout the day. Inside day for the most part across the major indexes. The momentum lines on the intermediate lines market forecast, really dropped sharply because of the small ranges. So this really was not able to get the follow through to get through some of these kind of weaker resistance levels, like at the 8-day moving average and the 23% line. Much less a stronger resistance that's above that we can actually move up towards. So if you can't get to the weak resistance, how are we going to get to the strong resistance? So that's kind of what happened today. I'm going to break that down, show you kind of what that did, what that looks like on the charts, what drove today's move. Big moves today in multiple asset classes. We'll talk about which ones. And then our trade idea is a stock that did better than the broader market. Actually, it's had a really good 3-day streak. So, if we're going to get more stocks like that kind of start to rally here in the short term towards resistance, how do we trade that? So today is an example of how to do that. So let's go ahead and get started. Today is Monday, May the 16th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we continued to be up off of Thursday's low. But we finished, again, the second consecutive day below this 23% retracement level. Remember, here's your resistances. Any kind of upward momentum we get, well, it doesn't mean we can't get through this, but it's going to stall right in this 4,200, just under 4,200 area. Multiple 38, 23, 38 Fibonacci across multiple time frames, all sitting right there. But you have to get above the 23% level on both of these first. We haven't done that. And the range today got really small. It's barely above half the average. So really, really small range. The near-term line got into overbought territory. The question is whether it's going to be something like this, right, where it gets into overbought territory barely and then turns right back down. And we get a new bearish leg lower. Because that would be a bearish high point if we only stay there for like a day, that far into it, only stay there for a day and then get right back to. So really important to watch. My leanings is that we'll actually move up, we'll break into this area right here. That will, by the end of the week, we'll be trading up in here. That would be my instincts. Because I think the intermediate line is going to make a run up towards 40. I don't think it's going to get above, or at least significantly above 40, but I think it's going to make a run there with a good near-term rally. But, we're 6% below this. We're set up for, potentially a divergent type low to the downside here. All the market forecast charts all look almost exactly the same. You can see the NASDAQ, same thing, near-term line's right above 80. We're still almost 9% below the 30-day moving average. The Russell 2000 is almost 12% below. Again, near-term lines is barely above 80. The intermediate lines coming off of multiple clusters in a row. The intermediate lines is barely... it's rising, but it's in the lower reversal zone. The momentum line on all of these fell because the range was so small. The range, after getting really significant ranges, including the gap yesterday, Friday, a very, very small range today. And again, like I said, unable to really break through. Again, it doesn't, the pullback, in this case to the upside, to the moving average to the upside, the pullback doesn't start until you break the 23% retracement level, and we haven't done that. And we haven't done it on this long-term decline either. So, you're still kind of just grinding down. And, we can trade anywhere between 23 and 0 and just kind of stay in this area and start to build up some volume and some support in that spot as well. So keep that in mind. And we can get gradually closer like this to the moving average, just with the moving average dropping and us working our way in that direction. Let's take a look at the weekly candle so far, and you can see it right now. It would be we obviously would not be closing below last week's low point, and very little chance that that's going to happen. We would also not be closing below last week's close on the Hakunashi basis. So you can see that that's that there's a sign that we might be slowing down the decline. That you can see the differential is not as deep as it was. The PPO is still falling, so it's not like we don't have a green arrow. It's not like we're turning around, but you can kind of see how it's not looking so bad, right? We got the potential for at worst some kind of neutral week this week. We still have 3 red arrows all across the board. We're pretty close to green arrows in the MACD. You can see all the MACD histograms are rising. They're all pretty much almost crossing 0. So we're really close to at least 1 green arrow. The stochastics looks like it's also pretty darn close to getting green arrows too. So we're still pretty decently away from the moving average, so we're not going to get 3 green arrows anytime soon. And when we do, it will be considered a selling signal because of the trend. But as of right now, we don't even have 1. So we're still in bearish mode there. When you look at the 2-line version of these charts, you can see the Harami pattern. You can see how we're still below the 8-day moving average. The MACD is, again, we're almost got the green arrow, so the MACD is almost above its moving average. You can see the volume really tapered off too, which is not really the best sign to see the range and the volume taper off already when we've only come off 1 day off that low point. But again, like I showed you before, that 23% retracement, there's multiple lines in this area around 14,420. That's where the bottom of the value area is. That's where your resistance is going to be. Probably where your 30-day moving average will be by the time, if we get up into that area, by the time we do, your moving average will have fallen down to that level. Let's take a look at the DMI. You can see we're still bearish. Like we're not getting more bearish. Like we're now below 30, but we are still above 25 in the negative. We're still below 20 on the positive indicator. Oops. Let's do this one. You can see same thing on the Qs, same thing on IWM, right? So we're not really changing the direction here. We're just not as bearish. SPX is still in bearish levels. Right? We're still below 40. We're still easily below 0. That's the case for the NASDAQ. That's the case also for the Russell. They're almost exactly the same chart. They're all right below that 23% retracement level. The trend is still very strongly bearish. We're still well below -5. We're well above 80. We're well below the green and the blue lines. So well below the cloud. Very strong bearish pattern across all these charts. IWM. So very mature trend. Mature trends like this is very hard to change unless we really bounce up sharply off of them. We are not, the bandwidth appears to have peaked, so this looks like maybe the bulk of the momentum right now to the downside has peaked, and it looks like it's starting to come over, which means we are not in the lower quartile. It doesn't mean that we'll necessarily rally, but change the trend, but it probably means that we'll start to at least kind of grind sideways here while the bandwidth starts to come back towards each other as the bandwidth falls and these 2 lines work their way back towards each other. We'll probably stay in this area. When I add on that second year of volume, you can kind of see the area that we can start to fill in for some volume if we just kind of stay up and down here. And I think there's a really good probability of something like that kind of pattern happening. Looking at the intraday chart, it's right here. We did get a higher high and a higher low, but we did not close above yesterday's high, nor did we close above last week's high. So very neutral candle from that perspective, sitting right on the 4-week point of control. The Qs look very similar, inside day, IWM, inside day. So very neutral, but at least neutral up in the upper end of Friday's range, right? The gap still held on IWM. The gap still held on the Qs. The gap still held on SPY. So at least that gap from Friday morning is still holding. I think there's a good chance it probably won't hold for very long. We might dip down there and form the higher weekly low, maybe as early as tomorrow morning before rallying back up towards last week's high, if not up above last week's high, towards this 418 area. Again, it'd be the midpoint of this 4-week range, so another layer of resistance sitting in that spot. If you look at the range and the volume, I showed you how it's already tapered off. So very small volume, 78 million, very small range, 6.37 points. Let me put those numbers in perspective. 78 million is way down here. That's not very good. Whatever, 6 points or so, yeah, it's way down here too. Again, you look at the daily price moves, and you can see it's not surprising when we get a 2% rally when we've had multiple 3% drops. You're going to get that kind of move to the upside, and we did. And then we had a really small move to the downside, and historical volatility is up above implied now. Implied volatility really dropped off like a rock here. In fact, look at the VIX, well into neutral zone, probably about right in the middle of neutral zone, even though we're still at 27 on the VIX, which means the VIX 3M remains stubbornly high, almost at 30, and that's, for us to be as bearish as we are, and for the VIX not to be as high, or to be much higher than VIX 3M, suggests that we might get a little bit of a decline here towards 90%, but I don't even think we're going to get this kind of decline. When we had all those bars over there, and we talked about how bearish that is for volatility, well, here we are again getting those same kind of bars, and expect bearishness for volatility, but most likely into this 90% area before it bottoms out and continues to trend itself higher. You can see when I look at the mean, the moving averages for the VIX, see where the average values are. We are below that 17-day moving average. We're still above the 30 and the 50. I think we'll eventually come probably down into this low 20s area, but definitely won't get down to the high teens, which is where we got down to over here. In fact, we got below 18 and a half. I don't think that's happening again. I think probably more likely towards the low 20s, 20, using 20 as a support like it did right there before bouncing back up and moving higher again. So again, we might get some weakness, like maybe as early as tomorrow morning, but more than likely by the end of the week, volatility will be down. The markets will be towards last week's high, if not above last week's high. And we tried to move up towards some resistance levels on the S&P, and this kind of be in this sideways noise, and then we'll work our way down. And I don't think we'll trend one way or the other for a while, but I think we'll work between resistance and support for the next so many weeks. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know what charts or indicators you're looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That goes a long way for us. It lets us know you liked your video. It lets us know you want us to do another one again tomorrow. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch if you don't want to. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or comments do you have about anything I brought up? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these things over here on the right. Click on this icon, takes you to our Market Outlook live page. This is on Monday, Wednesday, and Fridays at 3:30 Eastern Time. I do a quick 10-15 minute live video. I do it right here on this page, right before the market closes. We take a look at all the trades I've talked about in all these other Market Outlook videos to see whether we should stay in them or get out of them or not. We also talk about today's trade already. We've already done it. We've already actually put it on before the market closed, and we did it here during that video. You can see all the archives below here too. You can also get to it by clicking on Live Trade Review in our main menu. Over here, you can see our upcoming classes we have. If you click on View More, that takes you to our calendar. You can see all our upcoming classes we have for the rest of the month, as well as all the recordings we have going back 4 years there. Come down here, click on that heart. It opens up this new tab. Hit that like button. Same thing here, hit that thumbs up icon, come over here, hit that like button as well. Again, the more you do that, it really helps us get our content out to more of our followers because you can see it doesn't reach very many people unless it has engagement. So that's why we keep asking you. Just as simple as a like goes a long way for us. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. All right, now let's take a look at what's driving the price action here. You can see commodities continue their run. There's 25% over the last 3 months, and last week or so they've really rallied pretty strongly. Let's look at how things performed here today. Let's move over here. All right, you can see today the Qs were down the most. They were down the most earlier. They were down the most by the end. And IWM came down too. Along with other U.S. equities. Emerging markets really underperformed. Developed markets, real estate ended up the day at its lows. But on the other side of the spectrum, the weak dollar really propelled commodity prices and gold higher. And that's something we've been really talking about here lately is, the direction of the dollar and just how bullish it is, especially the dollar versus the yen, right? That we had that kind of big drop. Here, let's look at it on this chart. We had that big drop, what would that be, last Thursday to get below the 17-day moving average. We did get back above it, but have held the 8-day on the renewal, and the MACD is still below its moving average. And stochastic still dropping now into the lower half of the chart. So the dollar appears to be kind of rolling over there, and then against the euros, where the other section of weaknesses, and MACD is above its moving average, just barely. The stochastics is trying to turn higher from really low levels. We've been so low, we're so far below that 200-day moving average. So when I look at here and change it to 200, you can see again, it's really, really low. It's been a while since the euro has been this bearish relative to the 200-day moving average. It's the lowest of the past 5 years. But if you go out to 7.73 is where we're at. So there in 2014, going into early 15, we had this global slowdown. That year, we did get to minus 16, so about double, more than double where it's at now. In fact, we were kind of here for the most part before it took that next significant leg lower there. You can see in 2011, following the credit crisis, we got down to about this level below the 200-day moving average, where we started to work our way up higher. And then if I look at it on a weekly basis, again, we were pretty far below coming out of 15 and 16. We just based for multiple years because we were so bearish. But if you look at, beyond that, over into 2011, 2010, 2012, that's about as far below the 200-week moving average that we got before we started to turn things around. When you look at the whole moving average, first of all, let's look at for the S&P 500. You can see we've had multiple bullish candles now, and we're easily above the 20-day haul. Obviously, we're not going to flip that parabolic SAR tomorrow unless we get a significant move to the upside through resistance. Remember, these are the important resistance levels. The parabolic SAR is about to get below that. So we still have some room, multiple days. But the more days above the 20-day haul, the more likely we are to finally turn higher after well more than 20 days to the downside. And you can see this is where are we at currently relative to the 200-day haul, and the average, the 9-day average, is about as low as it was over here. So it's the red line, the purple line here is pretty deep, which you can see sets you up for that type of move there to the upside, at least probably again towards resistance levels. Whether it gets through them, like we did get through some pretty significant levels there. If you were to activate this the market sentiment line, you can see we ultimately got through the 62% retracement, even got pretty close to 78, which would have just really flipped things around, but we didn't. We got right back below the 62% a few days later, held resistance, essentially held basically a fake out pattern. Resistance held, and you can see, remember, fake outs are worse than resistance holding in the first place. So that's what happened over there, and so anything similar will probably get us into this area here. I don't think we're going to get any further up above that. So that's the S&P. So the euro US dollar, again, it did have a brief turn on green on the whole, multiple transition candles, but no bullish candles. Parabolic SARs didn't flip. We're getting a lot closer. So we had a couple bearish candles there, but the last candle, today's candle, is really neutral. And remember, we are really below the 200-day haul. So again, that sets you up for this bullish type move. And the dollar, the strength in the dollar has actually coincided with strength in equities for the most part. So it'll be interesting to see how that plays out. Bonds ended up today with a very small range. Again, unable to really change the trend here, right? Unable to get above the 17-day moving average. The MACD is above its average, but the value is not above its 17-day. So we're still not quite where bonds can make that turn higher. Bitcoin, kind of a reflection of that, of the bearish and the more aggressive end of the risk appetite scale, below its 1-year value area. trying to see what it wants to do with that 62% retracement. Very long lower shadow there. Again, it's kind of going in conjunction with what we're seeing with ARK Investments, and ARK Investments tried to make a run up above the 8-day moving average yesterday and it failed. It's right back down today. So that end of the risk appetite scale, there still isn't a whole lot of demand for that end yet. Let's take one look at the sector moves. So give me 1 second to look at the sector moves here. Right in this area. So there's the last 3 months. Not surprising with energy doing very well, that with commodities doing very well, that energy is doing really well. So, but you can see today, again, as bullish, or not bullish as we were today, it's your safe haven areas that still outperform. So it's still a pretty risk-off day, even if it wasn't necessarily the most bearish of days. Discretionary is a big loser here today. You can see down the most. If I were to take a look over here at the discretionary members, and we'll look at it here against against zero, right? So not a relative strength, but an absolute value here, and then just go back to a daily and go back to 1 day. So you can see the ones that kind of made some more significant moves today. But you can see, Tractor Supply had a really good move to the upside, but you had, again, Tesla having a relatively big move to the downside. That's significant because, remember, Tesla, and from a consumer discretionary standpoint, Tesla and Apple are just now starting to break their weekly moving averages, right? That 50 week. So they're just starting to correct, and it's going to be really, as we've seen, it's going to be really hard for the markets to be bullish if the bellwethers aren't bullish, whether it's Apple, whether it's Microsoft, whether it's Tesla. Of course, Facebook has already moved lower, and Google, Amazon has already moved lower. These are below weekly moving averages, and then Google is starting its correction. So you have a couple of the main stocks, at least the large mega cap name stocks, that have more than corrected. They have corrected through the 200-week moving average, deep corrections. You have others that are maybe about at worst a quarter of the way there, with still plenty of room to go to the downside. So that kind of tells you how much longer we are in the stage of correction from a broad market standpoint, when the generals still haven't necessarily gotten to that point yet. All right, so I wanted to point out Tractor Supply. Tractor Supply, we saw, was one of the bigger winners today in the discretionary space. If I take a look pull up its chart, you can see good 3-day winning streak after getting this piercing line last Thursday, gapping up on Friday and just running away so far. The intermediate line still in the reversal zone, so not strongly bullish here. The market sentiment line still dropping or well below it. So again, not strongly bullish. But near-term line making it, the momentum line spiked up to extreme highs on Friday, and then the near-term line followed that up by getting above the 90th percentile today. So really good short-term sentiment move, even though we're still 4% below the moving average. You can see it's the best short-term sentiment run that we've had. Even during this bullish run, we never had that strong of a rally combined between the momentum. So an opportunity here to kind of turn things around and get things going. You can see kind of similar to that. I don't think we'll get that big of a rally, but you can kind of see the big break in the near term level that brought the intermediate line finally up, in this case up towards bullish territory. When you look at its long-term chart, we've been getting so many bearish candles. Look at this week's candles, more of a transition. We haven't dropped below zero yet on the long-term PPO. When you look at the 3 green arrow chart, we are above, or at least we were for the good chunk of the day, we were above the 17-day moving average. There's a lot of volume, so again, and all these intermediate long-term moving averages above us, and they're falling. So it's not like we're going to be strongly bullish here, but at least there's an opportunity to get up towards these levels and get up towards the top of the value area here. towards that 50-day moving average. I think there's a really good opportunity for something like that to happen. You can see that we were strongly bullish. We were strongly bearish, excuse me. Now we're not. We're back below 25 on the negative. We're back above 20 on the positive. So we've kind of, as of right now, changed that trend. The RSI and the CCI are back up out of bearish levels towards not so bearish level, at least towards the upper half of the chart. You see that in the Bollinger Bands as well. We're not in that lower quartile anymore. We're in the middle of the bandwidth with an opportunity to make our way into the upper half of the bandwidth, and that bandwidth is falling. So again, we're not breaking out here like we were there, or we're at least, but we're done kind of moving to the downside, and we'll probably start to grind here in the middle. There's the Ichimoku cloud. You can see we did get above the green line. We're well below the cloud though, and the blue line. So at best, I think we fill in the rest of that gap. We still got a very strong trend, not mature. We're back below -5. But still pretty strong bearish trend and a pretty decent gap to fill in. So what I did, instead of being too aggressively bullish, we looked at, where was it? There it is. We looked at doing a short put vertical spread. So selling the 200, buying the 195. Don't have to worry about earnings. So position sizing full for a pretty decent reward. And you can see that break even ends up being right here at Friday's opening gap. So if we fill in that gap, if this ends up not being a runaway gap, and we fill that, look at that, higher high, higher low. We closed above it Friday's high. We closed above last week's high. So pretty good move today. But if we end up closing, I'm trying to make $450. I'm risking 1,000, but I would prefer only to lose what I'm trying to make. So I'm trying to make 450. I don't want to lose any more to 450. So but you can see with that break even, I won't lose that 450 unless we completely reverse this and fill in that gap and work our way back to the downside. At that point, I don't want to be bullish on it anymore. We'll be back below all those short-term moving averages, back to being more bearish. So that's a good opportunity. That's a good level for us to be kind of make or break, right? As long as we stay above it, great. If we break below it, then we want to be out of it and take whatever loss we get at that point. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums to open up any new thread there with any questions or comments you have. Apply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video below. Also, remember you can join our website at marketscholars.com for free. Like us on Twitter and Facebook. That goes a long way for us. We really appreciate that. Have a great rest of your Monday night, everybody, and we'll see you all next time.